Well, the share market's getting close to a record high again after bouncing back by a solid 1.1% today. Yet corporate earnings have been going down for years, so arguably it's getting harder to justify the expensive prices that people have been willing to pay for Australian shares. A similar trend is happening in the UK and Europe, while profits in the US are going gangbusters, though that's mainly being driven by America's tech giants like Nvidia, Microsoft, Apple, Google, and a few others that have seen their share price surge as a result of the AI boom, which some say is starting to resemble a bubble. In fact, these trillion-dollar companies have gotten so big they now make up 40% of the value of Wall Street's S&P 500. Now that's something the Reserve Bank says it's a little bit worried about in its latest financial stability review, because if these companies eventually have bad days and they go on for quite a while, that'll have a huge impact on investor confidence, which could flow through locally. But none of that got people worried at all today, with banks, miners and healthcare stocks driving the ASX higher. Meanwhile, the gold price also hit a new record, again, at almost $3,900 an ounce, while the Aussie dollar is trading at 66.2 US cents. And finally, markets in the US, Europe and Asia also went up as they weren't bothered at all by the US government shutdown, as they're getting used to US politics being dysfunctional. In fact, these markets are at or near record highs, but the equity risk premium has fallen off a cliff. So basically it means outside of Australia, a lot of people worldwide are also probably paying too much for shares, which could get a bit messy if company earnings don't improve significantly. And that's finance.